Hey everyone, welcome to the Dream Builders Insurance Podcast. I am Carissa.
And I am Marcy.
Thanks for watching. If you are joining us today, we're just going to go through some quick stuff about IULs. There's a lot of buzz about them now. So with that, I'm going to go ahead and let Marcy take it from here.
Okay, hey guys. So the reason why we're jumping on here and going to start to talk about just the basics of IULs is because there's so much buzz about tax-free retirement and not really understanding exactly how it works and who it's good for. Sometimes there are these misconceptions of people are seeing ads now since everyone's talking about this, different ways than being in the market. But they're ads that might be a little bit misleading to people. And, we're hearing various things from clients who think that they can start an IUL and immediately start borrowing from it, like ASAP. And that you honestly don't really do that in an IUL. So what we're just going to do is talk about who it's not for first. Okay, because I think it's super important that people understand that an IUL is life insurance, and I think everybody kind of gets that. And I just don't understand. I just don't think that they understand exactly like who it's good for. So I'm going to talk about who it's not good for. So if you are not saving money on a monthly basis, and you are just having a hard time paying your bills, and you think an IUL might be the way to go, honestly, it's not. And you don't want anybody trying to, per se, sell you on an IUL policy, because that's actually going to hurt you more than it's going to help you. There's kind of like a rule of thumb as far as what your budget should be. Now, it's just a guideline. So you take your age and you times it by 10. And if you can afford to put that amount of money into an IUL, that would be your premium each month, then you're in really good shape. It's just, you have to be able to fund an IUL properly in order for it to work for you. And the name of the game is not about the death benefit, which we'll be showing you how that works. It's not about like, I want $1 million of coverage and I only want to put in X amount of money. We really just want people that are mindful of they need to start doing something for retirement. Maybe you don't have a 401k. Maybe you want to supplement a 401k, or you have Roth IRAs, whatever it is. But at the end of the day, this is life insurance with amazing benefits. So age-wise, I think I'm going to say that if you are over 55, then you should not be looking at an IUL. And the reason for that is it'll take you way longer to build up cash value, right? And so it's not a get quick rich scheme type of deal. People do it on their grandkids, their children. You need to be relatively healthy in order to apply for coverage with an IUL. And it builds cash accumulation, not cash value, because that's more about whole life insurance. So I think that's about it. You have to qualify for it. And again, for me, the most important thing is that you have coverage and that you're able to afford the premiums on your budget, and that way you're leaving your legacy. All right. And now Carissa's just going to talk about who it is good for.
Yes, so an Index Universal Life Plan, I forgot to mention that from the beginning, an IUL, I always have to find your acronyms, right? Index Universal Life is, like Marcy said, it is life insurance. So let's say that you already have a retirement plan, but maybe you are overfunding it, which means that you're putting, like, let's say you have a 401k and your company matches, 3%, and you decide to put in 10% well, you're putting it over what your company matches. We could talk about in a separate video why that's not a good idea. But you've got 7% that you can then put into an index universal life plan. So that would be a better use for it. Or if you just, you like to save money, maybe you don't trust the stock market, but you still want to take advantage of some of the ups of the stock market, then an index universal life plan would definitely be the way to go. So that being said, how do you know? Maybe you already have an IUL and you want to know if what you have is even good. There's a lot of badly structured policies out there. And we just want to give you some tips to know, do you already have one that is poorly structured, okay? Because a lot of agents will structure IULs so that they give you a nice big death benefit, much bigger than you need, and therefore it gives them a really large commission. And then that death benefit, because the death benefit's so high, it's going to raise your cost of insurance and it's going to cut into your cash accumulations. That's no good, right? Because the whole purpose of an IUL, the main purpose of an IUL is the cash accumulation. Even though technically, yes, it's life insurance, the main purpose is cash accumulation. So if your main need is just a death benefit, then sometimes it's better to look at a term, because a term life, right, Marcy, a term is going to be much cheaper, and it's not going to build cash accumulation, but it'll give you that nice big death benefit. All right. Another thing that often we see that when we audit policies, or another thing that other agents see when they audit policies is that sometimes there are really small caps on, because in the way an index universal life policy works is that your cash accumulation grows based on the growth of an index such as the S&P 500. We'll just use that for because that's probably the most popular one. So if the S&P 500 is doing well and has some increase, and your cash accumulation will grow by a percentage based on the S&P 500. If the S&P 500 has a bad year and has a negative year, then there's a 0% or 0.25%, some kind of guaranteed percent floor that's always 0% or higher. So you will never lose what you've earned the previous year or what you put into it. Now, but there are some ways to lose what you put into it. And that first way is if your cost of insurance is too high. So let's say, we're going to show you an illustration later, but let's say you're only putting in, $300 a month and your death benefit is $2 million. Well, your cost of insurance is going to be so high that most of your premium is just going to pay for your cost of insurance. And so it's going to start eating into that cash accumulation. You will lose money. Even if the market does well, you'll still lose money. All right. So it's kind of just like a nice big blanket to say, oh, you can never lose money. Well, you can if it's not structured correctly. That's pretty, yeah.
Can I add one thing? I think it's truly important that you make sure whomever it is that you're going to work with is educated and on IULs and how they work, because we're not saying anything about people structuring them poorly, but it actually does happen. It's not necessarily a reflection on them. It will just be a lack of education and knowledge. We are not experts, but this is our focus. So this is what we've learned over the years, able to just to talk to you guys about it, for the folks who say, oh, well, it's just life insurance, or you'll probably lose your money just like you can in the market, right? It's not. And that's
right.
Why you work with people like us and seasoned agents that know what they're talking about.
Yeah, and that have your best interests at heart and realize that the main purpose of an IUL is for that cash accumulation. So on that, the last thing I'm going to say is that you want the smallest death. You generally want to get the smallest death benefit that the IRS will allow for the amount of money you're putting in. There's certain laws that we have to follow when we're putting these things together, and you have to have a certain amount of umbrella of insurance. So for the amount that you're putting in, if you put in $500 a month, then your death benefit has to match what your age is. It has to be the minimum amount that the IRS will allow. If you try to have a smaller death benefit than that, then the IRS will say, oh, we don't think you meant for this to be an insurance policy. And they will say it's now an investment, and they're going to charge you taxes on whatever you take out of it, which you never want, right? But the whole point is to be tax-free. So we're going to show some illustrations because a picture is worth 1,000 words. So we're going to show some
Can you just,
illustrations of
can
what we're
you,
talking about.
okay, can you just, let's back up for 1 second to explain to
Yes.
people. Well, I don't understand, but because I want to have like $500,000 of life insurance cover my mortgage. So what, even though we know how to structure it with the least amount of death benefit, but what do you advise people to do?
There's different things you can do. So if for an IUL, remember the main purpose is cash accumulation, not death benefit. So what you can do is some companies will actually allow you to add a temporary term rider. But you always, again, you got to make sure you're talking with an agent to make sure it makes sense. The term is going to be less expensive than the permanent portion of the death benefit. So sometimes you can add that to get that additional coverage. But many times it's just going to make sense to get a separate policy that's less expensive and it's a term. And therefore, that can cover your mortgage or, do whatever you need to do. And then the IUL will be what really builds your cash.
Awesome.
And if you put enough money into it, that cash is going to build and it's going to be added to the death benefit anyway. So you have to remember that the death benefit is going to get larger over time if it's structured correctly.
Amen.
So, thanks for keeping me on track as always, Marcy. So I think, Marcy, you're going to go over what we're talking about and what can happen if you have a poorly structured IUL. I'm going to share our screen. Let's see, we've never done this before. So it says it's sharing.
It's loading.
Oh, okay. It's taking a while, guys. Just bear with us. But Marcy, can you just go over some of the things you're going to point out in the bad example illustration?
So on a bad illustration, the first and foremost is all you have to do is get your policy out if you have an IUL, okay? And the most important thing is to let's look in the very first column, okay, where it says guaranteed assumption. And if you look where it tells you your account value in the middle, and then the surrender value, which is 0, and your death benefit is $500,000. Well, that right there is a poorly structured IUL because you should be having cash value in year 1. Okay, so that's basically, and the surrender value kind of is like your credit line, so to speak. So if you want to be able to take money out, this is basically saying you can't even touch it. And on the far right, it's showing you in the first 2 years when you could be turning to year 3 and already have maybe $8,000. Okay, so that would be your one clue if you notice that. Also, we have to make sure that you're paying the premium for long enough, right? And we want your coverage to last until age 100. All right. So if you look at your illustration and you're looking at when you're 85, let's say, okay. So if you're looking at it at 85, if you start to, like, I can see at 89 on the screen, it has your name in it. But if you look at 89 years old, I mean, you've gone from a death benefit of $500,000 and you have about 66,000 left. You can withdraw and every year you could get tax-free money, like sitting over there in the withdrawal column, which is $10,000. But to keep it extremely basic, is if your surrender value is 0 and in anywhere between year 1 and year 6, you can reach out to us and we'll just help you and show you what needs to be done. And then it's up to you of going back to that agent and having them rewrite it or whatever it is that you want to do. And the other thing is, because this is life insurance and you're leaving a legacy, yes, they get all that account value, but we're living a lot longer now. So we can't have our coverage running out at 80. I mean, my mom's 91. That would be crazy.
Right. And can I
Right.
mention one other thing about this horribly structured IUL?
Of course.
So another problem is that, as you can see, okay, the client is taking out and as a loan, which we'll talk about why you should always do loans later, but taking out a loan for 10 grand every single year, right? The bad thing is that by age 90, the client has put in $120,000, but they've only taken out a total of $250,000, and they only have $39,000 left in their surrender value, which is the money they have available to borrow from. And then their net death benefit is only $66,000. So this is a horrible policy because they're already out of money. They're almost out of money at age 90, and they've just barely doubled the amount of money that they were able to take out from, compared to what they put in.
Right.
So
Which is
it's really bad.
A little bit crazy.
Yeah. Plus, another thing to watch out for, I'm not completely forgot to mention this before. If you see how this death benefit is $500,000 and it never increases at all. So there are some situations where you'll want to have a level death benefit. But one thing I didn't mention earlier is that your level death benefit should not start usually, especially for someone who's younger, like this 40-year-old person. You want to only have a death benefit for someone who's older. So for someone who's younger, you want that death benefit to be increasing so that the cash value, this cash surrender value, will be added to the death benefit, and then you have it started being level right at here at age 65 when they have money start to be taken out.
Right. So when we structure for people that are over 55, because there are circumstances where someone even 62 can do an IUL, depending on how much they can front load it and fund it. But we would want to do a level death benefit for them, because if somebody 60 is looking at an IUL, the cost of insurance comes in huge. If it was increasing, right? It would be.
Right.
It would be.
Right.
It would be crazy. Yeah.
Yeah. So yeah, level death benefit for them. But for most of our clients, we do started out with an increasing death benefit, and then we have it going level as soon as they stop funding it and start taking out income. So, all right. Anything else we should mention, Marcy, about the bad, poorly structured IUL? This is just depressing to look at.
Yeah, it is depressing to look at. So I think you just have to remember about also the premium and how much you're able to put into it.
Yeah,
so that plays in control too. Like they have a minimum that you can put in, so that would be keeping your insurance enforced, meaning so it never lapsed. And so you might be paying $300 and know that your minimum is like $57. Okay, you can't keep doing the $57. So it's really important that we, again, like I said earlier, we have to stay really realistic when it comes to our premium, because that's totally going to affect the outcome of the policy and not work the way that it's supposed to be doing. And then, some people will say, I only want my policy to pay my premium for 10 years. So you can only do that in certain circumstances. So we're just going to have you a realistic view and know that, yeah, you put all this money in and you can stop paying your premiums and let it pay for itself. The one other thing that's a misconception I think that we should just add really quickly is that the death benefit is what your beneficiaries get. I don't understand, but people will tell you get the account value and you get the death benefit. So that does not actually happen. And again, that's just an education part about IULs, thinking that you get to roll it all together and your beneficiaries will be good. That's it.
Right. So, and then the premium right here, the planned premium, that's the $400 a month. So they just multiply it by 12, and then, some people pay annually. So that's $4,800 a year. All right, so let's look at how it should be structured. So in this example, what I did is I say, hey, client, you only want to pay $400 a month? No problem. First of all, like Marcy said, it's supposed to be 10 times your age minimum. So if a client comes to me at age 40, and then of course a year later, by year one, they're 41, that's what that means. But if they come to me at age 40 and they say they want to pay $400 a month, I say that's perfect, because they should be paying at least $400 a month, so it'll build cash. So we're going to skip these columns because we already know what they mean. And then, as you can see, there is already surrender value in the first year, which means that obviously there are, he has to pay for his cost of insurance. He's got to pay some other fees that we'll talk about in future videos. But this means that he's already, if he for some reason needed to borrow money from his policy, even in year 1, he would be able to do that. All right, it's not zero. By year 2, it's almost equal to the account value, and by year 3, it's pretty much the account value. So this means this is a well-structured policy. All I did was I went into the software and I said, okay, what's the minimum amount of death benefit this client can get for what he's putting in, so we can build the max amount of cash. So as we can see, the death benefit is only by this time $94,000, but it started out even lower than that. All right, then if we go to the next page where he's, like 100, we can see he's been taking out $21,000 a year. By the time he's 90 years old, he would have taken out put in 120,000, taken out 530. That's not bad. That's, many times more than what he put in. And then he's still got $175,000 worth of death benefit by the time he's 90 years old. And he only started out at less than 100,000 death benefit. So not only does he have more, he has cash still that he can continue to draw from, but he's also got a death benefit still that he can leave for his family. So this is the way it's supposed to be set up. And this is if you just say, hey, I really just want to use my insurance as a cash accumulation product. This is how you would do it.
Okay, I'm going to add one thing, unless you were planning on talking about that next. So when you're structuring the IUL for cash accumulation, let's say this client can only, they say $400 is what I can afford to do on a monthly basis, but I think, in about 3 years, I could probably add another $200 to it, so that Chris had explained, so we basically structure it so that we leave you enough room to be able to increase your premiums to have more cash accumulation too. Life changes, so if it changes for the better, and you want to add additional money, whether it's monthly or a year, you can do that.
Yes, but I would say do that only if you are definitely planning on increasing it in the near future. If you're not, then the best thing to do is just to get another policy later on, so that you can, not take advantage of the low cost of insurance while you can. That was good, Marcy. So yeah, that's basically, if your policy doesn't look like this, if it's not the minimum death benefit it can possibly be, if you got zeros in the first few years, if it's ending before age 100. Like this one does. This one, they're completely out of money and death benefit at age 95, which is awful. So if that's you, then please contact us. We'd be happy to do a free policy audit for you. Wouldn't cost you a dime. All right, I'm going to go ahead and stop sharing now. Okay. So, Marcy, I think we pretty much covered everything. Anything to wrap up?
I think this is just for people who are a little bit confused on what it is. We did not go into too much detail, and we will do that in future videos. That is it.
Good.